This is InvestTalk. Independent thinking, shared success.
Hey, Justin and Luke. This is Dan from Northern California. Big fan of the show. Want to get your thoughts on a company called Enphase Energy. ENPH is the ticker. They've gone down pretty dramatically in the last couple of years and seem to be reaching a reasonable valuation, but want to get your analysis on that. Thank you again so much. Looking forward to hearing your thoughts on the podcast. Bye.
Enphase Energy is what the question is about, ticker ENPH. It's a global energy technology company. They specialize in solar microconverters, energy management technology, and storage systems. Now, taking a look at its performance over the past year, it's pretty poor. Down 41.37% over the past 52 weeks, down 21% over the past 3 months. And what started as explosive growth in 2019 coming out of the gate turned into falling revenue. They hit a peak in December 2022 of $2.3 billion in revenue. It's projected to be $1.3 billion as of last year. And this year projected to be $1.6 billion. And in that time, net income has fallen as well. And margins started to slip. They reached a peak margin in 2023 at 19.2%. Net margin projected to be 7.2% this year. Along with that, cash flow has fallen almost in half since 2023. Now, they're an $8.6 billion market cap company. They don't have much debt. They also don't issue much shares. But one thing they do have a lot of is short interest, 15.52% short interest out there. Now, certainly, as the caller mentioned, as Dan mentioned, valuations have fallen. Price to book is standing at 9.3. At one point, it was 125. Price to cash was at 23.5. At one point, it was 204. Price to sales at 7. At one point, it was at 45. And so, yes, it is cheaper than it has been. Certainly is cheaper than it has been, and there's good reason for that. But my big issue is it's got a lot of headwinds. It's got a lot of headwinds. One, oil's cheaper. When oil is cheaper, people are less incentivized to invest and want this renewable technology. So that's number one. Number two, the political climate. There's a shift. There's a shift in energy policy. Less emphasis on a green revolution, more emphasis on the classic energy sources. And so because of that, even though the stock price has fallen 21%, it's down another 1.45% today, I just think the headwinds are too much, even to justify valuations which have come back down to earth, but maybe have more room to run downward. That is Enphase Energy, ticker ENPH. Gonna have to pass. Thanks for the call. We asked for a live call, and you came through. James from New York asking about TTI. Do you own it, or are you looking to buy it?
I'm thinking about buying it. I realize it's a plenty high risk play, but the thing I like is that they are launching a new water treatment tech for Permian Basin. So I was wondering if that might be an interesting. I know it's a small cap name, likely high risk, but something to explore during this time.
Awesome. Well, let's take a look. And, I will say things that are involved in the Permian Basin is certainly something that I would be interested in as well. So let's look at TTI, which is TETRA Technologies, Inc. It's an energy services and solutions company specializing in really developing environmentally conscious services and solutions within the energy sector. So they operate through their fluids and products division, their water and flowback treatment division. And most of their revenue is, guess what, split 50-50 between those two divisions. Now, over the past year, trailing 1 year, only up 4%, but the past 3 months have been pretty fantastic, up 53.85%. Looking at the revenue growth, not great. They actually are negative in terms of growth, down 8.9% on an annualized basis over the past 5 years. Their net income, though they lost money in 2021, they started to make money again, but really income has been all over the place. As of their margins, from 1.4 to 4.1, 1.5 projected this year, 7.3 next year. So what I see is, yes, a small cap, but also a very volatile one. It's only about $616 million market cap. They have $214 million in debt. So not a lot of debt, but it is, again, a small company. And at the same time, they're also issuing shares. up from 124 million to 132 million in that time that revenue has fallen. Cash flow looks okay, pretty anemic, not great, though it is headed in the right direction. I just see more than anything, like you said, an incredibly high risk name. Not just because it's small, but because their profitability, their revenues, everything is so volatile. Forward-looking price to earnings is at 11 times, so it's not too expensive, but price to book is sitting at about 3.9 times where it's been over the past 5 years. Again, I like names that are looking to improve efficiency, even environmental scalability, specifically with the Permian Basin. I think that from a thematic perspective, that's great. But you hit the nail on the head, right? This is an incredibly volatile name that certainly has gotten a little bit more investment recently with some upgrades from analysts, but I haven't seen much earnings upgrades and positivity on the earnings front either. So for me, it's a little bit too risky. I think there are better names out there that have more smooth investment experience, certainly, and better smooth revenues. Thanks for the call. Let's go ahead and play another question. This voicemail came in earlier.
Calling today about Crocs, ticker symbol CROX. I used to hold this company and sold it at a gain. That was a couple of years ago. And looking at it again now, the numbers still look good. The chart looks okay. I was wondering if you can take a look. If you think right now this pullback is a good time to get in, maybe hold it for a year, maybe two. Thank you very much. Have a good day. Bye.
So let's take a look at Crocs. That is ticker CROX. For those of you who don't know this company, though it is really taken the world by storm, I would say. I have a really good friend who has many, many, many different types of Crocs. She also has an obsession with ranch dressing, so she has ranch dressing themed Crocs. But anyway, Crocs are like sandals with a shoe cover that have a bunch of holes in them. And 10 years ago, if you said that this company would be as ubiquitous as it is, I would think you were crazy. But their growth is undeniably good. 30% on an annualized basis over the past 5 years. Their net income growth, 73% on an annualized basis over the past 5 years. Their net margins, stellar. 20% in 2023, projected to dip a little bit to 19% this year, but still remarkable. They've been buying back shares, down from 72 million to about 58 million. And they're not too big. They're a $6 billion company and they don't have much debt, 1.7 billion in debt. Their cash flow looks pretty solid as well. Now they're flat on the past 52 weeks, essentially only up about 3%. So they are underperforming the market on that front. And in the past 3 months, they're down about 20%. But what that has done is it has dropped them into a more reasonable valuation. Now, the reason why it's down this much is because they've had some issues with their Hey Dude brand, which makes up about 24% of their revenue. And so what I see here is a company that is coming back down from some pretty sky-high valuations, considering its line of business. Everything else, with the exception of falling revenue within that one division, looks pretty good to me. So frankly, I think this could be a solid buying opportunity for Crocs. That is ticker CROX. Thanks for the call. Now on Fridays, we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.27% today. For perspective, last week it was at 4.266. 26 weeks back, it was at 3.882, and 64 weeks ago, it was at 5.05. The 10-year Treasury yield was at 4.619% today. For perspective, last week, that was 4.609. 22 weeks ago, it was 3.921, and 64 weeks back, it was 4.63. Gold was priced at $2,774 per ounce today. Last week, it was at $2,708, and 64 weeks ago, it was at $1,935. Silver today was priced at $30.68 per ounce. Last week, it was at $30.33 per ounce. 50 weeks ago, it was at $22.80, and 145 weeks back, it was at $23.94. Oil was selling for $74.56 per barrel. That is a decrease of $3.64 compared to last week. 18 weeks back, it was $67.79, and 60 weeks ago, it was at $74.30. The national average for a gallon of regular gasoline is $3.13, a 2-cent increase compared with its price last week. 86 weeks ago it was $3.56, and 134 weeks ago it was $4.25. In California, it was averaging $4.44 per gallon, a 1-cent increase over last week. 64 weeks ago it was $5.32, and 140 weeks back it was $5.87. For comparison, in Iowa, gas was averaging $2.91 per gallon today. That is $1.53 less per gallon than gas in California.
Hello, InvestTalk guys. This is Greg from New Orleans. Just wonder if you could look at Johnson & Johnson. I've been watching it for a couple of years and seems to be at a good price right now. I'd like to know what you think. Thanks.
So the question is about Johnson & Johnson. They have a really easy ticker to remember because it's JNJ. Now, Johnson & Johnson is a massive company. It is a diversified company as well. They have med tech, they have innovative medicine, they have all sorts of home health products, and they had a lot of revenue growth from the pandemic. The revenue grew from $82 billion to $95 billion in just 2 years. And that was really the bulk of the revenue. That's fallen off since then, understandably. The at-home tests weren't bought as much. The protective gear wasn't bought as much. And so because of that, you see the revenue fall off. Now, as I mentioned, it's a large company, $353 billion market cap company. And their cash flow, though the revenue has fallen off, has remained pretty stable. And in fact, in 2024, it went up from $22 billion to about $26 billion. So that's certainly something we like to see. Their margins have also started to head in the right direction again. They peaked out in about 2021 when their net margin was 22%. And then they hit a local bottom of about 5.6 in 2023, but in 2025, their net margin's projected to be about 28%. On a relative valuation perspective, they're decently below their 5-year average, trading at about 13.9 times forward-looking earnings, about 5 times book value, about 4 times price to sales. And so in the fourth quarter of 2024, their revenue was pretty solid. Their earnings per share, $2.04, beat analyst expectations of $1.99, but the company did provide some pretty conservative forward-looking guidance heading into this year. They also have had some pretty strong performance out of their oncological portfolio, their cancer treatments. And so the question is now a good time to buy Johnson & Johnson? Well, everybody probably knows it's probably not the best political climate for them. Certainly, there are some within the Trump administration that are adversarial towards Johnson & Johnson, not just because of the COVID vaccine. But either way, I think if you're looking for a pretty well-diversified health company that doesn't just have the med tech, doesn't just have the medicine, but has a whole portfolio of treatments and products, I think Johnson & Johnson can be a pretty good one. But let's take a look at their technicals, take a look at their momentum. They've really been on a downtrend since September and have been consolidating in the 140 to 150 range for a while. So I would honestly watch this name. I would keep it on my watch list and wait for the trend to kind of set itself into a new direction after this period of consolidation over the last month or so. That is Johnson & Johnson, ticker J&J. Thanks for the call. Now, we've answered a lot of voicemails. We've answered one live call. So let's dip into the InvestTalk YouTube question bank. And for those of you who do not know, though we do mention it all the time, so I don't know how you would not know, we have videos now available that show the show in a different way, as well as exclusive content over on our YouTube channel. Just head over and search InvestTalk with 2 T's. And if you have a question while you're over there, feel free to leave it into the comment section. And this question is from Jason Willis, and it says, TSP investing 10 years out of retirement. How about TSP investing 10 years out of retirement? Pretty simple, short, sweet question. And so the first thing for our listeners is, what is a TSP? Because this doesn't necessarily apply to everybody, right? A TSP, it's a retirement savings plan. It's for federal employees, also for military service members. It works similar to your 401k, right? It offers tax advantage savings with both traditional and Roth options. It also has 5 core index funds generally, and a life cycle fund, and there's also an employee matching. And so the question to me is posed as, maybe is it too late to start TSP investing 10 years out of retirement? And I would say it's never too late to start. In that, yes, it's always best if you start young, but just because you didn't start young doesn't mean you shouldn't start now. If you have the ability to get an employee match, if you have the ability to take advantage of the tax benefits of this TSP, just because you are 10 years away from your retirement, doesn't mean you shouldn't start. In fact, I think you should start today. Thanks for the call, or thanks for the comment. So I don't know if people have noticed, but US stocks are riding pretty high. And some investors are starting to worry about just how expensive they have become. The latest numbers, in fact, show that the equity risk premium, the extra return investors demand for owning stocks over safe government bonds, has dropped to its lowest levels since the dot-com boom of 2002. That's because the S&P 500's forward earnings yield, a measure of expected profits relative to stock prices, has fallen to 3.9%, while the 10-year Treasury yield has climbed to 4.65%. So what does that mean? Well, that means that investors are now accepting a lower compensation for stock market risk than at any point in over 2 decades. In fact, investors are piling into dominant tech companies really without much concern for risks at all. The Mag 7, tech giants like Apple, Microsoft, Nvidia, they've powered the S&P to record highs. But what that has done is it has left fund managers with a pretty tough choice. Do you keep chasing big tech, which has largely driven equity market appreciation over the past couple of years, or do you diversify? Now, some argue that today's valuations, some people call them the mother of all bubbles, but some people say they're justified. Ben Snyder from Goldman Sachs says that when factoring in interest rates and economic conditions, U.S. equities are fairly valued. And as long as corporate earnings keep growing, stocks should continue to rise. But is that a simplistic explanation, given that earnings are always justified so long as, valuations are always justified so long as corporate earnings justify them into the future? And then there are others that see red flags. Chris Jeffrey at Legal & General. He warns that U.S. stock prices have become increasingly disconnected from global markets where valuations are much lower. And I can see that side of it too. If you take a look at U.S. market returns and you axe out NVIDIA, the U.S. market is a lot more like international market returns. And so is this a concentration effect? But there's also a concern about treasury yields. If bond yields keep rising, at some point, stocks could become too expensive to justify holding over safe government debt. And we already touched on it, but what about those corporate profits? One could argue that today's high earnings margins are out of whack with historic norms, meaning that in the future, mean reversion, they could shrink. And if that happens, investors could face lower than expected stock returns, right? People talk about the forgotten decade. And with equity risk premiums already near record lows, there might not be much room for error here. But regardless, nevertheless, momentum is still pretty strong, especially in tech. PIMCO's chief investment officer has warned that bond yields and stock valuations are as stretched as they've been in years, and some investors justifiably fear that concentration in a handful of mega cap stocks could pose a risk to the broader market. And so here's what I say. Is 2025 the year of diversification? While tech stocks have led the way, the imbalance in valuations may push investors to look beyond the biggest names. Just because the index was positive doesn't mean all stocks were positive. And so, if the index is flat, It doesn't just mean all stocks are flat. If it's down, it doesn't mean all stocks are down. Diversification still is the best way to deal with risk, mitigate risk, and look for better returns. Now it's Friday, and we are moving pretty quickly to start the weekend. But it's not the weekend yet. So let's play another InvestTalk listener question now.
Hi, InvestTalk. I wanted to see if you guys could take a look at Booz Allen Hamilton, ticker's BAH. I bought it at the end of last year, and it's up so far this year. But I've been meaning to call and ask what you guys thought about it and the sector that it's in, and if it's a good company to hold on to for a long-term hold. I'll listen on the show. Thanks, as always, guys. Bye.
So that's ticker BAH. That is Booz Allen Hamilton. It is a tech consulting company, management tech consulting company. So they offer analytics, digital solutions engineering, and cyber expertise. Now, the revenue is pretty split between their defense clients, their civil clients, and their intelligence clients. But certainly, in the age of cyber warfare, in the age of boosted defense, in the age of growing threats, a company like Booz Allen Hamilton could stand to benefit, especially with the prevalence of artificial intelligence, a race for artificial intelligence, everything moving to the cloud, their analytics, their digital infrastructure. They also have a lot of government contracts, the DoD, a lot of federal government departments. But let's look at the revenue growth. Very strong. Almost 10% on an annualized basis since March of 2020, from $7.4 billion to projected to be $12 billion. The end of this year, the end of their fiscal year 25 is actually in March, so coming up pretty soon. And that's still pretty good growth. That's almost 20% from last year. What about their net income? Well, the net income has grown at 7.6%. And their margins have been improving as well. They reached a peak in 2021 at 7.7, but it's trended in the right direction ever since, projected to be 7.2% this year. Cash flow looks pretty solid. They have about a little bit of debt, about $3.6 billion on a $17.4 billion company, and they're buying back shares. And they also, unlike a lot of cybersecurity firms, pay a pretty decent dividend, 1.5% on an annualized basis. Dividend yield. Now, looking at that, right, over the past 6 years, pretty steady. 1.3, 1.4, 1.7. And their dividends per share has been growing from $1 6 years ago to about $2.09 is where it's supposed to be this year. And yes, they bought back shares, but not enough to really have that be the driving force in the dividend growth. And so what I'm seeing here is a company that has pretty solid earnings upgrades over the past couple months. Company that has cash flow headed in the right direction, margins headed in the right direction. Pretty solid thematic choice with cloud computing, security, artificial intelligence, good government contracts, and trading at a pretty reasonable valuation. Only trading about 1.5 times sales, only about 19.8 times forward-looking earnings. Now, they're only up 3% over the past 52 weeks, and most of that has come this year, down 20% in the past 3 months. But either way, with this pullback and with how important cybersecurity is, and with a pretty solid valuation and decent growth, I like it. Booz Allen Hamilton. Thanks for the call. Now, we got plenty of time, so let's head back to the InvestTalk YouTube comment section question bank. Tackle this one on inflationary fiscal policy. It says, even though inflationary fiscal policy is slowing down the rate cuts, we could still get tax cuts for small caps by Q4 and likely some sort of rate anticipatory debt restructuring on their balance sheets going into 26. Wouldn't the market anticipate this and give us a significant holiday run in 2025, assuming this is the scenario? Well, here's the thing. The macro picture is complicated. It's incredibly complicated. If you look back to Trump's first term, tariffs didn't have that much of an effect on hurting the economy. The reason why is because the order of operations, right? You had tax cuts, deregulation, then tariffs. This time around, you get inflationary fiscal policy, potentially, tariffs, then down the road, tax cuts, right? We don't know the degree to which there will be tax cuts. Certainly, the tax cuts will at least be extended, but the market can only anticipate probability of scenarios, right? And so if the market is pricing in pretty robust tax cuts now, well, then the market is already reflecting those tax cuts now. And any surprise on the positive or negative side between what can get done is more likely to change prevailing market direction. And as you get closer to those events, well, it becomes a more input on the overall sentiment. But what we're seeing now is the other side of the order of operations, the things that can be done more quickly, the tariffs, trade policy. And so that's really been a key focus of not just us, but market participants in this year. But the general thing I want to say, because I need to emphasize this, the market has trillions of dollars of money moving, with people taking sides of trades in milliseconds and digesting a bunch of information. It's not as easy as boiling down to one thing driving price action. And so to answer your question, should tax cuts float the market headed into 2026? 2026 is a long time away. A lot can change, and I'm sure there will be a lot of things that change in 2025. Thanks for watching. Bill from North Carolina, thank you for being patient. You have a question about NVO?
Yeah, hi, Luke. I saw that this stock is, pulled way back, and heard commentaries on it today on CNBC. There was a diverse opinion on, whether they would get, more than enough market share between them and Lilly and maybe some up-and-comers as to how that affect their earnings in the future. It just looked like maybe a pretty good investment at this point. I don't know as much about the company as I would like to. I need to do some more research, but, they've been in the news for several years. What can you tell me an insight as to whether this would be a good buy point?
Yeah, well, that's a great question. And, Novo Nordisk is very well known for their weight loss drugs, right? 93% of the revenue comes from their diabetes and obesity segment of their business. 7% comes from rare diseases. But the point here is if you are buying Novo Nordisk, you are buying obesity drugs. That's it. It is not a diversified business generally. Now, the reason why it pops so much is because of phase 1 data for their new weight loss drug. And so it's up 8.47% today. But as a business, it's run pretty well. It's about $270 billion market cap with $8.5 billion in debt. Its cash flow is improving. They buy back shares. They pay a solid dividend. And their earnings have been upgraded. Their revenue growth is stellar, 13%. Almost 14% over the past 6 years. Their dividend growth is solid too, from 44 cents to $1.90 projected this year. And like a lot of pharmaceutical companies, they got pretty solid margins, 36, 34, 35% over the past 3 years. And so the question really is two-front, right? If you want to get a concentrated investment in essentially diabetes and obesity treatment, right? This is a good way to do it. But I would say to you, 8.4% pop in one day on phase 1 data. There's a lot of way to go. So I think this thing will probably start to consolidate again, come back down. This is a little bit of, irrational exuberance. Even though it's down 22% in the past 3 months, I would never buy something like this after a pop like that. I would wait for it to consolidate and find out where it wants to be. And then I would start to dollar cost average into it. Thanks for the call. Have a good weekend. Before we head off, I wanted to talk a little bit about tariffs. And that's because there's a potential reviving of protectionist policies reminiscent of the late 19th century. President Trump's latest announcement that included a 25% tariff on Mexico, Canada, as well as a potential 10% tariff on China, could create a global supplemental tariff as well on imports from other countries. So what's the goal? Well, the goal is to boost American manufacturing and fund tax cuts. But history suggests the reality will be quite different. Higher prices for consumers will likely be the immediate consequence. When Trump first imposed tariffs on China in 2018 and 2019, studies showed that prices rose nearly 1-for-1 with the cost of the tariff. And while Trump claims foreign companies will bear the cost, economists argue that American households will feel the impact most, with everything from cars to electronics to groceries becoming more expensive. Now, some of his advisors, including Scott Bessent, who would be Treasury Secretary, and Stephen Moran, acknowledge the price increases, but argue that tariffs will also strengthen the US dollar by reducing demand for imports. A stronger dollar, they say, could really help to offset these higher costs, but history tells a different story. Studies from Johns Hopkins show that Trump's previous tariffs only accounted for about 20% of the dollar's movement at the time, meaning the benefits of a stronger currency were pretty limited. Meanwhile, American exporters could suffer. If tariffs push the dollar higher, U.S. goods will become more expensive for international buyers, making it harder for American companies to sell abroad. At the same time, major trading partners like Mexico and Canada are already signaling retaliatory tariffs, meaning the U.S. industries could face new barriers in key markets. So what does this all mean for the U.S. economy? Probably slower growth and potential inflationary risks. Tariffs distort the economy. They force businesses and consumers to pay more for goods that could be produced more efficiently elsewhere. Studies show that previous tariff reductions actually helped spur innovation in industries like manufacturing by increasing competition. Protectionist policies, on the other hand, could lead to stagnation. Even historical tariff champion William McKinley eventually recognized the downside of economic isolationism. And so as Trump presses forward with his tariff agenda, businesses, economists, and consumers are bracing for the impact, hoping that history doesn't repeat itself. I'm Luke Guerrero, and this completes another InvestTalk podcast. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads at iTunes, Google Play, and Spotify. Remember, we can help you understand your portfolio dynamics, calculate your risk number, optimize your 401k, and build you a full financial plan. If that sounds interesting, just head over to investtalk.com and hit the portfolio review button. It is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.